Hey guys, welcome to the channel. Welcome back to another video. On this quick video, I want to talk about the latest Federal Reserve updates to the economy. Fed President Jerome Powell has come out and given more updates about the outlook in his recent address at the Brookings Institute. So I want to have a conversation on this video about what was said and about where the Federal Reserve seems to be headed in terms of interest rates. So guys, it appears that the Federal Reserve is going to do a pivot. And when I say a pivot, I mean they're going to sort of change their policy from being so aggressive with the rate hikes, and they're going to sort of dial that back just a little bit. We know that they've done 4 straight 75 basis points increases, or 0.75%. And we know they've done 6 rate hikes already this year. Now, they're probably going to do another rate hike, but it's not going to be 75 basis points. Now, I don't know that for sure, but that's sort of what it sounded like based on what the Fed chair said. Now, during his recent speech at the Brookings Institute, he talked about what's called core PCE inflation. Now, the core PCE inflation is one that the Federal Open Market Committee, who actually sets the rates, looks at pretty closely. And so what the core PCE inflation rate is it's the inflation that does not take in consideration food prices or energy. Okay, food prices and energy, as explained by the Fed chair, are sort of volatile, and they don't look at those in these numbers specifically. Now, they look at them, but they don't focus on them when they talk about the core PCE of inflation. So the information the Fed chair gave us was that the core PCE inflation rate for right now is 5%. In October of this year, it was 5%, which is exactly what the core PCE inflation rate was last October. So 1 year later, and inflation has kind of flatlined. In other words, inflation is still higher than they'd like to see. So we do know that the forecast of inflation in general has been saying inflation should be going down. These rate hikes should be having an effect. Well, guess what, guys? These rate hikes are not having the effect that the Federal Reserve anticipated they would. So these forecasts that they've been using and we've been looking at and talking about have not been working. They haven't been working for the type of inflation that we're seeing right now. So the Fed President Jerome Powell came out and said, we're going to shift from looking at some of these forecast models, and we're going to start looking at some of the macroeconomic factors that are leading to inflation. And we're going to look at those macroeconomic factors to help indicate to us that inflation is in fact going down and getting near their 2% target rate. So he basically outlined 3 things that they're going to be doing and 3 things they're going to be looking at. So number 1 is what they've been doing, right? Making sure that they continue to raise interest rates, not at the same level that they were raising rates, but they're going to continue to raise rates until they see some indications of getting to that 2% inflation rate. The Fed has already raised rates 375 basis points this year. They've raised the federal funds rate. That's 3.75% already. Now, of course, the federal funds rate is not the rate that we see. The federal funds rate is just the rate that banks charge one another for overnight deposits, okay? And that trickles down to the consumers, and the banks pass that along, and the lending institutions pass that along to us in the form of increased mortgage rates, increased auto loan rates, increased rates on our credit cards, and things like that. So it gets passed down to us. Now, he also said the ongoing increases in the federal funds rate are appropriate, and more appropriate now than they even thought they'd be just a couple of months ago. So that's the first thing. Continue to increase rates with a pivot to not be as aggressive as they have been. Now, the second thing he talked about that they plan to do or plan to look at is he said they want to slow growth and aggregate demand. In other words, slow down the demand somehow. And he actually said they want to see a substantial period of a slowdown in growth. So when they start seeing that, that's an indication that inflation is slowing down. He said basically that slowing of demand is going to actually allow supply to sort of catch up to demand and restore some balance in what they call price stability. That's what the Federal Reserve is all about. And that's a buzzword they always use. They want to see what they call price stability. And so based on what the Federal Reserve President Jerome Powell said, they want to see a substantial period of below trend growth. What is below trend growth? Below trend growth is basically a smaller GDP, a smaller increase in the GDP. Now, what we know so far this year is that GDP has sort of been like flatlined, right? So GDP was down slightly for a couple of quarters in 2022. The last quarter, it was actually up slightly, but it hasn't had real big swings. So it's been sort of flat. GDP is basically gross domestic product, right? It's the total value of goods that have been produced and the total value of services that have been provided. That's the GDP. So the Fed is telling us right there, they want to see a slowdown of GDP. Now, they don't want GDP to go backwards, right? The Federal Reserve does not want to see GDP decrease for 2 and 3 and 4 straight quarters in a row, right? Now, they're saying they don't want to see that because obviously that represents the textbook version of a recession. So they don't want it to go backwards, but they want it to slow down. They don't want the growth to be huge. They want to see GDP grow less and grow slower. The Federal Reserve is saying we need to see a sustained longer period of slower growth of GDP. That's the second thing that they're looking for as an indicator that inflation is coming back down to their target rate of 2%. Now, the third thing they talked about was a little bit more complex. The third thing that the Federal Reserve President Jerome Powell mentioned in his talk at the Brookings Institute is what they call core PCE inflation. Actually taking the core PCE inflation and really dissecting it into 3 distinct areas that they want to look at and focus on as they monitor inflation. The first thing was the core goods inflation rate. So the core goods is everything except for energy and food. All other goods are included in what they call the core goods inflation. Now, the core goods inflation, as he mentioned, is down about 3%. Just goods alone, down about 3% this year. That's a good thing, right? That's just goods itself. So they do anticipate the cost of goods to continue to go down. And hopefully, as he mentioned, help push all of inflation down slightly. The second piece to the core PCE inflation that they want to look at is what they call housing services inflation. Now, the housing services inflation is looking at basically rents and what they call rent equivalents in the housing market. And when they focused on that particular piece, they see that there's still some incline in inflation at about 7.1% that's taken place, 7.1% over the last year. So that really hasn't come down. And we know this because we know rents are out of control. We know rents are higher than they've been forever. And the prices of rent have skyrocketed pretty much all over America. So we see evidence of that one right there. But he also said this particular measure tends to lag behind because rents usually happen on a yearly basis with 1-year leases. Now, he did mention that new rental leases are a better indicator for this because it's more timely, right? Inflation rates for new rents have been as high as 20% in the last couple of years. Now, they've fallen a little bit, as I mentioned, but they're still a little bit high. So that's another indicator. The third indicator is labor and what they call inflation and core services other than housing. So that really includes labor. Now, that particular piece, it makes up more than 50% of what they look for in the core PCE inflation. So that one's really important. And labor is one that I've talked about on previous videos, guys. Labor is going to be really, really important. Now, he said inflation and other services other than housing include things like healthcare, education, hospitality. He even mentioned haircuts, right? So it's everything other than housing that has to do with services that are produced. He went on to mention in terms of this category that the demand for workers currently far exceeds the supply of workers. Wages is a big piece of that. Wages are currently increasing far above what we normally see if we want inflation to be down to 2%. So there's a lot of things to cover with what was said. But I want to give you guys this quick update to say, hey, the Federal Reserve is starting to make a pivot in their policy. They're starting to be less aggressive with these rate hikes, and that's going to be evident at the next meeting in a couple of weeks. Overall, he said monetary policy should stay fairly restrictive until real signs of inflation decrease happens, and they want to get down again to that 2% target rate. Hey, if you got anything at all out of this quick update, guys, do me a favor, smash the like button, and also drop a comment. What do you think is going to happen with rates in 2023 moving forward? And what do you think is going to happen at their next meeting in 2 weeks? I hope you guys got something out of this video. Do me a favor, check out some other videos regarding the state of the economy on this channel. Hey, the best person to take care of the old you is the young you. Do me a favor, take care of yourself, and always take care of other people. Until the next video, peace.